Hey everyone, Mr. Tweet here. Today I'm going to be going over what's known as the spending multiplier, or sometimes called the simple multiplier with you. And then I'm going to be going over the tax multiplier, which is almost the same thing. So here's the thing. When we go to close a gap, we don't necessarily, the government doesn't necessarily need to spend 100% of the money that it would take to close the gap. Because when the government spends money, then that money goes to somebody as income, and then they spend money, and then somebody gets the money as income, and then they spend money, and then it works like a ripple effect. So that when you add spending to an economy, right, it kind of ripples out, and the initial spending amount ends up multiplying throughout the economy, right? So like the government sends me $600 for stimulus because of the pandemic, and then I take that $600 and maybe I put like 100 of it in the bank, and maybe I take $500 and maybe my wife and I go away for the weekend. We take a trip up to like Palm Springs or something, right? And so while we're in Palm Springs, we use some of that $500, and then maybe we go to like a really nice restaurant for dinner. Right? So we go to a nice restaurant, and we get some good food and order like an expensive bottle of wine, have a really good time. Well, that money, it's not like it disappears when we spend it, right? The restaurant is getting paid that money. They're going to be using that money for stuff, to pay employees, to be like buying stuff for the restaurant. The owner of the restaurant gets some profit out of that, right? So the owner of the restaurant, he's got a little bit more money, or she's got a little bit more money now, right? The company that like sells bottles of wine to the restaurant, they that company now, they've made some more money, and they're going to pay some employees, and their owner gets a little bit of profit, and it just keeps rippling that way, right? The waiter, right, he gets a tip from us at this nice restaurant, so he gets a nice $30-$40 tip or whatever, right? That $30-$40 tip goes into his pocket, and then maybe he goes and he's like, I'm going to put that $40 towards a new game for my PlayStation 5. So he uses that $40 plus a little bit more money. He buys a new video game, or maybe he takes that $40 and he uses it to buy gas for his car. And so that money goes to a gas station, or the spending it doesn't stop. It keeps rippling, right? But every step of the way, some of that money is going to get saved, or it could get saved, right? So typically what you see is for like a population, like the United States, or maybe California, or maybe a city or whatever, for a population, we can actually measure what percentage of money gets spent and what percentage of money gets saved. And that was something that I had you do earlier in this Pear Deck, was I had you go through, and we can calculate what percentage of money people save versus what they spend. And it's got to equal up to 100% of the money that they get. So that like, if you get, let's say, a $20 check from grandma for your birthday, and you put 10 of it in your savings account, and then you take 10 of it, you buy a burrito, right? Well, you spent 10 out of $20, that's 50%. So that means that your marginal propensity to consume, that just means like on average how much you consume, is about 0.5 or 50%. And then you put $10 in the bank, that means your MPS, your marginal propensity to save, that's 50%, 0.5. So if we divide the change in spending by the change in income, or the change in savings by the change in income, we can calculate an MPS or an MPC. And then once we have those, we can then take those numbers for the population, and we can figure out what happens when we have a change in government spending. So we end up with this equation right here. Change in GDP equals 1 over my MPS. That's what we call the simple multiplier, or the spending multiplier, times the change in spending. All right. So if the government decides that they want to spend, like, let's say the government's going to spend $100 billion. And let's say that people save 10% of the money that they get. So 1 over 0.10, right? Well, a good way to think of this, something that helps me, is I think of this in terms of money, right? This is $1 divided by a dime, or this is, 1 whole divided by 1/10. It's the same thing as $1 divided by dimes, right? How many dimes go into $1? 10. So I got 10 times 100, right? Which equals 1,000 billion, or $1 trillion. So that's how we can use this equation. Now, you might get a situation where you might have a question where it could say, assume that the gap that you want to close, the GDP gap on your graph, let's say that the gap is 500 million. And let's say that MPC equals 0.8, right? All right, so what do? Well, the first thing is we need MPS. MPC plus MPS equals 1. So if my MPC is 0.8, then I know my MPS equals 0.2. All right, so MPS is 0.2. So then I plug into my equation, my gap that I want to close, the total change in GDP that I want is 500. So the gap is going to go over there for the change of GDP. We got 1 over 0.2 times. We're trying to figure out how much money the government needs to spend to close this gap. That's my unknown. So notice that like when you're given a gap to close, that goes over here. The amount that you need to spend to close the gap is your unknown. Same equation, it's just we're solving for something different here, right? So I end up with 500. 20 cents goes into $1 5 times. So I get 500 equals 5x. I'm going to divide both sides by a 5. Those cancel. My answer is x equals 100. So what this means is that if my MPC is 0.8, if the government spends $100 billion, it would, or $100 million, it would close a $500 million gap. Right? And then you could show that on the aggregate demand, aggregate supply model. You can even use numbers to show the size of my gap is 500. And then you could say right off to the side, spending 100 million would close that 500 million gap. Now, that's what happens when we have a change in spending. When we have a change in taxes, it's a little bit different. When we have our change in taxes, what ends up happening is some of the money gets saved before it ever hits the economy. So if it's tax cut, right, the government says, hey, there's a recession, right? Taxpayers, we're going to cut your taxes by $1,000. Well, taxpayers are going to be like, sweet, you're going to cut my taxes by $1,000. I got $1,000 extra dollars. What am I going to do with that? Well, I'm going to put some of it in my savings account because that's what MPS is. And then I'm going to spend some of it. That's my MPC. So some of it never becomes GDP. If the government gives you money back and you don't spend any of it, there's no GDP there. That's just a transfer of funds. That doesn't count for GDP. So when we have taxes involved, we have to take an extra step. We have to multiply the amount that's the taxes. We have to multiply by MPC, the amount that actually would be spent. It's also true when we have a tax increase, that if the government increases our taxes, right? Let's say the government increases taxes by $1,000, right? People are going to pay for that with some money, some of which would have been spent, some of it would have been saved. So if I have to pay an extra $1,000 to the government, right, I'm going to send them $1,000. Some of that's coming out of money that I would have saved, maybe 200. Some of it's coming out of money that I would have spent, maybe 800, depending on what the MPS and MPC are. So it's very, very similar to the spending multiplier. The only difference is when we have taxes, we have to take the extra step of multiplying times the MPC. So for instance, right, let's say that the government wanted to do a, I don't know, we could say $400 million tax cut. So there's my tax cut. And then let's say that the MPS is 0.1, right? So that's people save 10% of their money. Well, then that means I need to multiply this times a 0.9 because of that $400 million, I think it's a tax cut. Of the $400 million, when it hits people, they're going to spend 90% of it. So that's why we multiply times 0.9. The other 10% never goes to the economy. So they're going to multiply. So we end up with x equals 1 over 0.1, that's 10, times 400 times 0.9, that's 360. X equals 3.6 trillion or billion, whatever it was. I don't know, millions, billions, whatever, right? 3,600 million. That's our answer there. So we use the same equation in the same way. Now, if we have a decrease in government spending, or in this case, if we have an increase in taxes, right, then it's just going to go the other way. You can use a negative if you want, you don't have to. So like if we have, for instance, like a tax increase, you could be like 1 over 0.10 times a negative 400 million, because that's money that's coming out of people's pockets, times the 0.9, and you get X equals negative $3.6 billion. And again, that means that like it's just saying that that money's coming out of the economy, that the GDP is shrinking by, you know, that 3.6 billion rather than GDP growing. So that's, we can use a negative when either we have a spending decrease or a tax increase. You can throw a negative in there to show that GDP is shrinking and not growing. Or you can just, if it's an FRQ, you can just say that the economy would shrink by $3.6 billion. All right. So that's our multipliers. Spending multiplier, tax multiplier. We typically, you see it in two different ways. One of them is like, here's a gap. How much do we need to do to close the gap? Or another way you might see that is like, here's the change in spending or taxes. Here's the MPS. What would it do to the economy, right? So those are the two ways that you typically see this. So I have some practice for you guys to go over, but that's the simple multiplier. So have a good one.